ATMA, the monthly meetings what we used to have, and today we recommence 2015 with renewed vigor to start our monthly chapter meetings. Today we have with us Mr. Kora Reddy, an engineer, but with a bug for the markets, and by popular demand he is back again after speaking on quant last time, and an author of a book, Profitable Trading Systems. He is an avid reader, a prolific ARP supporter, at least that's what it looks on the Facebook and from your posts, and more than that, a person with a lot of knowledge about quant-based activity statistics. Today he is not only having his own website, stocksiq.com, but apart from that, he is also servicing clients in the US, and his articles have also they've been picked up, parts of them, by the Wall Street Journal, etc. He's also advising and programming for a software for a broking company and a hedge fund in Singapore. So with that sort of experience, and let's learn a lot from Mr. Kora Reddy. Can we have a round of applause and invite him to speak? Yes, sir. Let's see what the season begins as. Thank you.
Sincere apologies. Actually, last week I had to go to my college and I missed my flight. Actually, it was in Bengaluru. And sincere apologies for not making last week. Can you hear all of you? How about now? So what I was saying, yeah, sincere apologies for missing the last week ATMA meet, because I had to go for an alumni meet in Bengaluru and somehow I couldn't make. And thanks for coming here. What I'm actually going to talk today is basically how to look for the trading patterns, especially in seasonals, something like that. Unlike most of the slides where I would, or where anybody could say, okay, this is the trading strategy and this is what the performance, I probably would like to take through some Excel sheets and how my mind works or whatever. So you could, it might be a boring session or whatever, but like you probably are able to appreciate a little bit of Excel skills or whatever. Perhaps you could try your own, design your own trading system. That's what my aim is. What is this? Yeah, so unlike a slide where after a few definitions and this, probably we would be working on an Excel so that we try to pick up some of the seasonal trading patterns by walking through an Excel. This is just a straight textbook definition from web which I picked up. So basically the seasonal term in your Webster dictionary, a period of characterized by or associated with a particular activity or phenomenon which is relating to some of the season. And by definition, when it comes to your seasonal trades, you basically have a start date and you have an end date defined by some criteria of your own. And so you could pick up any seasonal trade, saying like, okay, I want to go long on 5th trading day of February and exit on 8th day of February or whatever. And you need to, that's one trading strategy. And then how do you measure? You need to measure. If it is like, let's say giving you like 10 points in Nifty or 0.2% in Nifty, it's useless. Or it's just like you're making the brokerage. So you basically measure any of the seasonal trading pattern that occurs to your mind. So you measure by some of these parameters, which I will tell you. The second point is, when it comes to seasonal trades, of course in US you have like 50 years of data because the market is there for more than 100 or 120 years. So you have all the data publicly available or whatever. So you have like a lot of data to work with. Whereas in India, the markets are like you don't have much data. Even the BSc might be open before 80, but the data that they provide, I don't know how accurate it is. That is like extrapolate and backwards. But reasonably, if you go to NSC, you get the data from 94, which is like 20 years of data. Which is like, sometimes, let's say if I have a trading strategy saying that like first trading day of the January, so you only have 20 trading samples, which is reasonable enough. But again, not so great, because sometimes I look for like at least 25 sample or something. That's one thing you need to keep in mind. But as I say, like 10 years of data is what minimum you need to look, and about somewhere in the range of 16 data points, if possible. I'll tell you what 16 and 25 and all that in the next slide or somewhere. So most of the seasonal trading strategies that I arrive with are basically programmed, or I work on Excel rather than any other big tools. And how do you do that? So you basically download your NSE or Nifty data or whatever you want to work with, or Bank Nifty, Nifty or Sensex or VF stuff. And then this is like theory which will actually come into practice. So once you download your OHLC and volume data, is possible. But again, we are not looking at the volume, so we look at mostly the flows of the Nifty, because most of our trades would be like enter today or exit tomorrow close, enter today or exit after 5 days, or enter at the month end and exit at the next month, something like this. So because we always look for close to close. So when you are doing that, so I'll actually come to second, third bullet, and you will see that in your Excel sheets. So these are some of the important points that you need to consider when you arrive at a seasonal strategy and when you are trying to measure. Number of years analyzed, as I said, like look at least for a minimum of 10 years. And then percentage of winning rates. So this is like a little psychological factor. As a short-term trader, probably you prefer like 80% of the winning rates, which has a reasonable expectation. Or you actually can make money even if you are like successful for 4 out of 10 winning trades. That's 40% of the trade. But again, as a comfort factor, you at least need to look for more than 65% or something like that, or at least more than 55%. And the 55% comes because like you go long on any day on Nifty, it's like probably up by 55 times out of 100 times, whereas it's down around 45 times. The last 10 years or last 15 years or last 20 years, wherever you take, basically the market has a little edge on the long side. So it's not 50-50 probability, but it's more of a 55 on the long side and 45 on the short side. And for you to go long, it's like basically even if you bet on any day, your chance is like 55%. So when you are like doing all the research, at least you make it to 65 so that you are doing some work.